How's it going, guys? And welcome back to the Blockware Intelligence YouTube channel. My name is Blake Davis, and we are back for episode 9 of Crypto Equity Investing 101. This episode is going to cover market breadth and sentiment indicators. So we're starting to get a little more nuance in the market and start to dive deeper into some of those under-the-hood market dynamics. As always, please remember that none of the information in this series is investment advice, and I am not a certified financial advisor, and that nobody should pursue any investment strategy without conducting their own proper due diligence. So let's get into it. And first, let's talk about what market breadth actually is. So breadth refers to the amount of stocks that are participating in a given market move. So the way I like to think about it is that market breadth is the foundation that the trend stands on. So what we would like to see, if we're talking about a move to the upside, you would like to see a wide breadth or a large market breadth, because that indicates that there's a large amount of stocks participating in a given move. If you have narrow breadth or a smaller market breadth, if you will, while the market is rising, that's an indication that less names are participating in the move despite the index rising in price. So this could be a signal that maybe just some of those larger cap names, your Teslas, your Amazons, your Microsofts, are the names that are driving the indexes higher, and there's not really that foundation underlying saying that there's multiple names in multiple different industries all contributing to this market move. So we're looking for a increasing breadth as price increases as a signal of a strong foundation with less individual points of weakness. As I'll show you guys in some examples here very soon, we'll look at examples of times where the market was increasing in price, the major indexes were increasing in price while breadth was narrowing, and what you'll see is that tends to lead to downside moves in the near future for the indexes, as there isn't that strong underlying foundation of many names participating in the rally. So there are a bunch of different indicators you can look at to gauge the breadth of the market. My personal favorite is the advanced decline line. So the advanced decline line measures breadth by examining all stocks in an index, and then it calculates its value by giving a stock a +1 if they are up on the day, and then a -1 if they are down on the day. So what that does is that leaves us with this value that indicates if stocks are in a net incline or decline, and it tells you exactly in aggregate how much the underlying stocks in an index are advancing or declining. So what we're looking for is, like I said, we want to see breadth expanding while the price of the index is increasing. So we would like to see that AD line rising alongside the price of the index. So here's an example of using the AD line in a real world example, and we're looking at the QQQ here, which is a NASDAQ ETF in late 2021. So we're looking at this previous market top here, and at the bottom here in this blue line, you can see the AD line for the NASDAQ. And in these gray boxes here, I've highlighted an example of what I just talked about. So what we saw here is on this last little push that the NASDAQ made higher, and we made this all-time high that, of course, has not been retaken, is you saw price was increasing here while breadth was narrowing. So this is the AD line, and you saw that AD line falling while price was rising. And if you were tracking the AD line at the time and watching market breadth, this would have been a potential signal that something was wrong under the hood in the NASDAQ. So what you would like to see is generally in moves like this and in moves over here as well, where you have strong increases in price in the index, you'd like to see more and more names participating in that market rally. So that's what you see when you see price increasing in breadth, or the AD line increasing alongside it, right? We saw it here as well. This is the last push up before finally something triggers under the hood where stocks begin to sell off. And of course, the NASDAQ is a market index, so there's a lot of names in the NASDAQ. So sometimes it can be a little bit lagging to what stocks are actually doing because there are so many names in the index. It can take time for what's happening under the hood in individual stocks to finally affect the whole index. But that's why we follow market breadth, because market breadth will signal that something's going on with the individual stocks. The saying goes, it's a market of stocks. It's not a stock market, right? We need to track individual names to sort of understand what's going on in the entirety of the market, and that's what market breadth and studying market breadth aims to do. So now we can talk about a second breadth indicator, which is very similar to the AD line, and that is called the McClellan Oscillator. So the McClellan Oscillator is essentially a MACD for the advanced decline line. And if you don't know what a MACD is, it's an oscillator that's essentially comparing moving averages to each other to judge trends in individual stocks. And the McClellan Oscillator works similarly in that it's comparing moving averages of the AD line. So if you remember, a moving average is just generally we use it for stock prices, and that's comparing the closing prices of a stock over X amount of periods to find an average, and then plotting that average onto a line that changes every single day, right? It's moving, assuming you're using a daily time frame, of course. And the McClellan Oscillator and using a moving average on an AD line is similar in that we're looking at the average value that the AD line has been at generally on the daily time frame and comparing to the two of those moving averages. And the McClellan Oscillator uses a 19-day and a 39-day moving average. Not exactly sure, where those numbers came about, but that's what we use for the McClellan Oscillator. So it works similar to the AD line, and if you could think about the AD line as the raw data, and then the McClellan Oscillator gives you a different perspective on the data, and we're more so looking at the trend, and it can tell us a little bit different things than the AD line just by itself can. So oftentimes it comes down to just personal preference. Some people like to just use the AD line. Some people only use the McClellan. I believe that there's use cases for both of them, and I use them both kind of in tandem. But of course, it's just personal preference. So now we're going to look at the same example we just discussed with the AD line using QQQ in late 2021. But instead, we're going to use the McClellan Oscillator so we can start to understand some of those differences between the two. So down here at the bottom, this is the McClellan Oscillator, and it might look a little different than what you were expecting. But as I just mentioned, we're comparing the spread between moving averages. We're comparing the distance between two moving averages, and that's what this histogram plots. So when the shorter-term moving average, the 19-day moving average of the AD line, is above the 39-day moving average, you're going to see a green bar in this histogram, right? Because you want that shorter-term moving average over the longer term as an indication that spread, or the market breadth, is expanding in the short term greater than over the long term, which would be a bullish trend in market breadth. So what you can see is that on days like these, when the index was increasing in price and breadth was expanding, you see all these green bars here on the McClellan Oscillator. And the higher that spread is, or the higher that the 19-day is over the 39-day, the larger that green bar is going to be. So what the McClellan Oscillator kind of indicated to us here in this move, and you can see this box, and these boxes are where I'm focused, is that the McClellan Oscillator had peaked out pretty early in this move to the upside, as an indication that breadth was starting to narrow, between these two moving averages. And you can see that in towards this area and here and in here, the McClellan Oscillator was essentially flat, right? You have these green bars that are somewhat significant, but what we'd like to see is big green bars like we saw in here and over here and over here, and those are stronger indications of market breadth. So when you see these shorter bars, that's an indication that market breadth is essentially flat and it's not expanding as aggressively as we'd like to see. And then, of course, you see in here that the McClellan Oscillator flips negative, right around in here, going into this last move to the upside off the green 10 EMA here. So it's similar to the AD line, where the AD line had topped out and was declining in this period, and the McClellan Oscillator is already negative. And that negative breadth is expanding as well, or breadth is contracting fairly aggressively during that period. So that is the McClellan Oscillator, an example using it, and you can see just some of those differences between using the McClellan versus just the AD line. But of course, as I mentioned, I think there's value in using them both at the same time. So now moving on from market breadth, we're going to talk about market sentiment, which is fairly related, and those two concepts kind of go hand in hand with each other. And market sentiment is the overall attitude or emotions that market participants are feeling towards the market. So if you remember episode 1, when we talked about trading psychology, and we talked about how fear and greed are the two primary driving forces for market participants, market sentiment is examining just how much fear or just how much greed there is in the market. So it's important to understand how fearful or greedy that we are personally feeling in our own trading, but that also we need to see how much fear or greed there is, in aggregate in the market. So market sentiment has a pretty important dynamic in the market, and a lot of it has to do with market cyclicality. So what will happen is markets will generally top when investors are overly euphoric, and then bottom when investors are in max panic. So it kind of makes sense when you start to think about it a little deeper, in that, at a market top, when everyone's so euphoric, there's more potential sellers than there are people left to buy, right? If you think about 2020 and everyone was so euphoric, or in going into 2021 when the market topped, everyone was so euphoric, everyone was trading is so easy. You had Davey Day Trader, and you had Robinhood, and you had all this euphoria in the market, where, the market is essentially green every day. It's so easy. And you see, people quitting their jobs become full-time day traders. That's euphoria. And that comes around the top of market cycles repeatedly over history, right? If you look at the 2000 dot-com bubble, it was very similar in that you have people quitting their jobs to become full-time traders. You have, max euphoria. The market goes up every single day. It's so easy. Everyone's talking about trading. Everyone and their brothers giving you stock tips. There's an old saying that says, when your shoe shine boy starts to give you stock tips, that's the time to get out of the market, right? When your cab drivers are talking about the stock market, when everyone on TV is talking about the stock market, all your friends are talking about the stock market, it's generally a sign of, max euphoria, and it is a signal around market tops. And the opposite is true around market bottoms. So at the depths of a bear market is where you'll see max panic, and you'll see, those people who were quitting their jobs to become full-time day traders are now going back to their old line of work, right? You'll see funds closing down. You'll see all these signs of max panic. You'll turn on the TV and it's, CNBC market in turmoil, and sentiment on Twitter is terrible. All those kinds of things are generally where markets will bottom. So if you think about, 2020, when the market bottomed, it was March 23rd, 2020, and that's kind of the peak of COVID fear that we had, because that was when, the government was starting to say, hey, we need to quarantine at home. We don't know exactly what to expect, and people were terrified. And at that point, the market bottomed, which was surprising to a lot of people. But if you understand market sentiment, it would actually make sense, because at that point, people are so fearful that essentially everyone who was going to sell their stocks out of fear likely already has. And in 2020, the amount of fear was so great, people didn't know what exactly the coronavirus was. People thought it was going to be the new Black Plague and wipe out half the world, and everyone panicked and sold their stocks, and that's exactly what you see in a stock chart, right? You saw mass panic, with the indexes down, double-digit percentages in a day. It was just crazy panic, and around those times is where markets will bottom. So examining market sentiment and looking at some of these indicators that I'm going to share with you are super important to understand, just exactly where we are in a market cycle, and this kind of relates to last week as well. But looking at market sentiment alongside breadth can be a great help for us as traders and investors. So I'm going to discuss two sentiment indicators, just as I just discussed two breadth indicators, and I should forewarn you that these sentiment indicators largely use options data to determine market sentiment. And the reason for that is that institutions use options largely as a hedge for their positions, or as a way to protect their positions. So if we look at what's going on in the options market, we can start to understand how aggressively institutions are hedging their positions, or lack thereof. So when they're hedging their positions, very aggressively, that's a signal that they're fearful for what prices are going to do in the short term, and is a indication of very bearish sentiment. And of course, when they have no hedges on, or very little hedges on, that's a signal of them being greedy, and of them expecting higher prices to come. So the first one I'm going to discuss is the put-call ratio. And you don't need to have a big understanding of options to understand these indicators. So the put-call ratio is measuring the number of open long put contracts in comparison to the number of open long call contracts. So if you don't know what a put or a call is, these are types of derivatives. And essentially a put, if you're long a put, it's essentially a bearish bet, and you are going to profit if the price of that underlying index or stock declines in price. And the opposite is true with the call. You would make money if the price of that underlying index or stock rises. So by comparing the ratio between the number of long puts and long calls, we can understand just what the sentiment is like currently in the market. So since this is a ratio, and we're dividing the number of puts by the number of calls, a ratio of 1.0 would indicate neutral sentiment, and that the number of puts and the number of calls is equal. Of course, when there's a higher value, that would indicate that there are more puts than there are calls, which would indicate that there's a more bearish sentiment out there. And of course, the opposite with a lower value would indicate a more bullish sentiment in the market. So once again, we are going to use this example using QQQ from late 2021 moving into 2022. And this is up to date to today when I'm recording this on June 29th. So looking back at that market top that we've discussed previously, what you can see down here with this is the put-call ratio in black. And you can see that the put-call ratio was fairly low here. It was towards this, I drew a black line across the bottoms here around this area where the put-call tends to bounce. And what you could see is that the market was essentially hovering around that lower limit, around that max bullish limit of the put-call. And that was right around the market top. So if you remember, we just talked about market breadth, and we saw that breadth was declining and less names were participating in the rally. But that was alongside extremely bullish sentiment. And that was a signal that, hey, maybe there aren't as many buyers left in this market as there should have been, or as there were earlier in the market cycle. So if you combined your breadth and sentiment indicators, it was a pretty good signal that this rally was getting pretty long in the tooth. And of course, it was impossible to predict, the extent of what the market would do from there. It could have just been a correction down to the 50 or 200 day, or it could have been something much greater, like we know it ended up being. But what I've also drawn here, and with these four other boxes that you can see, these are areas where the put call was at a maximum extreme. So that's extremely bearish sentiment, which are areas where the market will tend to bounce. So what you can see is on these four areas where you see these peaks in the put call ratio, these are all areas where the market put in at least a few day bounce. So just examining these sentiment indicators and understanding just how fearful or how greedy market participants are feeling can be a good signal of when we're due for a bounce. And of course, it's not exactly the best to use for trading every single day. In that when it appears that market participants are greedy, they can always get a lot more greedy. And when it appears people are very fearful, people can become a lot more fearful. But it is a pretty interesting thing to look at, and it is fairly helpful to us when looking at market cycles and even trading in a shorter time frame. So the last thing we're going to discuss today is the volatility index, which you'll commonly hear referred to as the VIX. Now, there are volatility indexes for other market indexes, but when you hear about the VIX, they're probably talking about the S&P, right? The S&P's VIX is the VIX essentially. And what the VIX does is it measures the implied volatility for put contracts. And obviously that requires a little bit of an options background to understand, but I'm going to put it a little more simply in that, when we're looking at the options market and we're looking at put contracts, which are, if you remember, a long put is essentially a bearish bet. So when demand for those bearish bets is rising, the implied volatility is rising. And implied volatility is the expected volatility in the future on that particular index or stock. So it's looking at how aggressive of a price move are we expected to see in the near future. So when demand is rising for these puts, implied volatility is rising, and the VIX measures that. So by looking at the VIX, we can see essentially how much demand there is for these bearish bets on the S&P 500. And this is why you'll hear the VIX also referred to as the fear index, because when the VIX is rising and people are placing more trades on put contracts or long put contracts, people are essentially more fearful. So it's a pretty good indicator of market sentiment and fear in the market. So now we're going to look at an example using the VIX, and this time we're going to use SPY or SPY, which is that S&P 500 ETF, and that's on the left, and the VIX is there on the right. And I've color-coded these boxes that are aligned in their time period just so you can see exactly how this relationship tends to work. And what you can see is that for the most part, the SPY and the VIX move in opposite. So if you want to start here on the left-hand side, and of course this is late 2021 moving into 2022 again. If we look at this blue box, this is a period where the index was rising in value. This is one of the last major runs that it made. And what you can see is that the VIX was very low. This is an indication that there wasn't as much demand for put contracts, and that sentiment was relatively greedy, or you could say the opposite, that it was not fearful. And then, of course, when you see these the indexes start to roll over or start to move to the downside, you'll see spikes in the VIX as investors become more fearful and start to maybe bet that the index is going to continue lower. So that's what you see sort of in this red box. And then, in the green box is where the index really rolled over and undercut that 200 SMA there. You can see in black, and what you see is the VIX is spiking. That's just showing this, spiking demand for bearish bets on the index, which is a sign of fear. And then, of course, in yellow, when you see these bear market rallies, you'll see fear kind of fall off a cliff, which is pretty classic. That people are we're out of the water, everything's over, and fear falls off this cliff, and people become greedy again, and that will sort of continue over and over until you reach the bottom of a bear market, where you'll start to see a rally, but people won't become greedy. People are still scared. And they use it just as an opportunity to get out of stock, or for the most part, people are out of their positions in cash for the most part, so you won't see that fear fall off a cliff towards the bottom of a bear market. But that's kind of a different market sentiment. I'm sort of looking at this top here just because a lot of us have experienced this. A lot of people were around in the markets 6 months ago. So it's a good example of just understanding exactly how these sentiment indicators and using the VIX have played out of recent. So that is all I have for you guys for this week. I hope you learned a thing or two about market breadth and sentiment. If you're enjoying this series and received some value from this video, please consider subscribing to the channel, leaving a like on this video, and commenting below with some feedback. As always, my Twitter DMs are open, and the link is in the description in this video if you have any questions or any other feedback. But thank you for all of you who stuck around to the end, and I appreciate you all watching. Be sure to come back here to this channel next week for episode 10. I think it should be a good one, but have a great week, everyone.